Now, as and when which you come across, if A falls under keep informed category, you please mention that. Now, as you feel that any one of them falls into that category, just keep informed. Just put your answer there in the box, and then we'll discuss whether it falls under that or not. Keep informed is the second category, wherein level of interest is high and the power is low. Power is low, but they, seek to motivate others and then instigate others, and then so that category, keep informed. Do you think A will fall under that? Do you think A will fall under that category? They are currently lobbying, isn't it? So that is one important thing. See, technically they may not have that power, but they have that level of interest. So the level of interest is understood in. Am I audible? Nobody is responding. Okay. The level of interest is in terms of lobbying. Here we see that they're currently lobbying various national governments. Then they are also they have arranged high profile protests in recent months. So with this, we can understand that they have interest in this particular activity. They are influencing. They are influencing other groups. Okay. So will A fall? This A, this one falls in that quadrant of keep informed. Do you think so? It falls under that category of keep informed. Am I audible? Do they have high power?
Yes.
Answer say.
Hello? Huh?
How does it reflect that they have high?
చెప్పండి.
They have media support. Okay. LPP is currently lobbying various national governments in an effort to reduce pollution, especially those from motor vehicles. LPP has arranged a number of high-profile protests in recent months, which have received a large amount of media attention. LPP is aware that K is about to launch a new model of motor cars, which is which is large and consumes significant amounts of petrol. They have media support, okay, in supporting their protest, in supporting their interest to raise an issue here. So the first, they have attracted the media attention. They have attracted the media attention, but as such, media was not there with them. It has they have attracted. The point here is they have only the level of interest. They have level of interest which is very high. So that's why they are lobbying, they are protesting, they are attracting the media, all those things are there. So the level of interest is only high. It is not that their power is high. Power is high or they are very powerful is not mentioned anywhere. But right from the beginning, we understand that they are very interested in this particular protest and uh, kind of creating an awareness against the pollution and all those things. Interest is high, so we can put a LPP into that category. So this comes under keep informed category. So we can select B. Do you understand that? Okay, okay. Then the next one is the government of country H. Just give me one. The government of country H, around three quarters of PLC's factories are based in country H. Um, the very basic thing that it is government of country H. We need not read anything apart from that. Government is very powerful, so we cannot take this stakeholders as stakeholder with low power. They have high power, so we need not even read across that. So when the power is high, it doesn't fall under keep informed. When the power is low, then we have to think about it. So it falls under keep informed, provided it has high level of interest. Then comes C. KPLC sales staff. K sales staff make up around 25% of the total workforce. They are not significantly unionized and are relatively unskilled. They are all based in K's head office. K is considering reducing the number of sales staff by around a third as part of a cost cutting exercise. Are they powerful? Are they powerful? No, they are not powerful. So we need to look into that. Um, they are not powerful. Then is their level of interest high? Will this fall under keep informed? Can they be ignored? Minimal effort. Can they be ignored? Can they be ignored? That's the question. Why can they? Why should they be ignored? Why can they not be ignored? The important points what we can draw from here is they make up around 25% of total workforce. It's a big percentage, and they are based in the head office, so they cannot be ignored. That is the important point what we can draw from this. They cannot be ignored because they are located in the they are placed in the head office, and if there is an action about cost cutting and reducing the number of staff and all, then that will impact because 25% of total workforce, um, they are they will have a definite impact on the total workforce, isn't it? So they are not significantly unionized, yes, but they are into unions. It's not that they're completely not unionized. They are not significantly unionized, but yes, they are into unions. Okay, so that's important point there. Level of interest will be high. Definitely, it will be high. The fact that they are placed in the head office, the fact that they form a major percentage of the total workforce, um, will any action taken against them, because they are also part of the unions, that level of interest will rise. They cannot be, minimal effort doesn't apply here. They cannot be ignored, because once they are ignored, then that can cause an issue there. So we can put C also under this category. Then D, F Limited, a consumer of KPLC. F Limited runs a small chain of car retailers. They exclusively sell K. They exclusively sell KPLC's two-seater models of motor vehicles. F only represents around 0.5% of KPLC's total sales. K is considering discounting the two-seaters range in the near future. Will this fall under that? Can we put D under that category? Respond. They have low power. Okay. They exclusively sell KPLC's two-seater models of vehicles. F only represents 0.5% of KPLC's total sales. But is the level of interest high? K is considering discontinuing the two-seater range in the near future. Minimal effort. Okay, power is low is fine. But is there anything which we can draw from this particular small paragraph about it, that we can straight away discard that it is minimal effort? anything, any part of it which can be given importance, and then which we cannot discard it, that um, considering to discontinue in future. Yes, that's the issue. They are considering to discontinue in the future. They are the ones who are exclusively selling. There's no other one, no other business which is selling this two seater models of motor vehicles. They are exclusively selling. So in that case, um, if they discontinue that, all the resources, the men, the people who are involved in the protection of this cannot be observed elsewhere, then they will have their level of interest high to see that this doesn't discontinue and it continues. If it was that there's some other competitor also, some other unit also is into the manufacturing of this particular two-seater model, then in that case, once this is discontinued, the resources can be diverted towards that. But because this is exclusive sale of these vehicles, it cannot be diverted to any other thing, but then it has to continue here. That is important point what we have to highlight. And then this D also falls under that category of uh, keep informed. So first class, someone asked me whether it is case study based. You understand, these are mini cases. Strategy itself is about various issues and the decisions which have to be taken. So we cannot straightforward put this one as they are case studies which are given. The the size and length of the question may not be very big and vast and large. It is a mini thing, but it is definitely looking into various aspects. Okay, that's how we understand that. But I think 25th we've done yesterday only. We finished 25th yesterday. Quickly, let's look at these questions and then go to the PPT. Corlo Pasta Limited is the manufacturer of chilled ready meals for a large supermarket chain. It recently found that a batch of products had a different type of meat contained in the meals to that described on the packaging. The company immediately reported this to the Food Standards Regulator, the Central Government Food Standards Agency, as this was a breach of appropriate legislation which could lead to heavy fines and penalties being levied on the company. The managing director of Furlough identified, while undertaking stakeholder analysis using Mendelow's power interest matrix, that the CGFSA had shifted from one stakeholder position to another. Which one of the following options correctly describes the shift in stakeholder position of the CGFSA? Keep satisfied to keep informed. Who should be satisfied? Who should be informed? Let's look at that the matrix. Okay, keep satisfied are with low interest, high power, and then your answer was okay. Keep satisfied to keep informed. So Nishya has answered it as C. Is the level of interest low or high? D also. Only one, no? Which one of the following options? Only one. It cannot be more than one. Okay. Um, B, D, C. Someone answer A also. We'll finish it up. Okay. Um, let's understand. Is the level of interest low or high? Others also please respond. When the questions are being discussed, it's useful for you only, isn't it? The company immediately reported this to the food standards regulator, the central government food standards agency, as this was a breach of appropriate legislation which could lead to heavy fines and penalties being levied on the company. The managing director of Perlo identified while undertaking stakeholder analysis using Mendelow matrix that CGFSA had shifted from one stakeholder position to another. D, 18 students are there, so I should get immediately 18 answers. Tuck, tuck, tuck. Keep satisfied to key player. All of you agree with D? Anyone can explain why D? Why do you think D is the appropriate answer? Keep satisfied to key player. So both of them under if we are going with D, most of you have answered D. If you're going with D, you understand that both keep satisfied and key players they are discussing about the level of interest. So earlier um, the level of interest was low and now the level of interest is high and their power is high. Any one of you, please. As you say, we'll note it out as D. But somebody, if you can justify why D is the right answer, then I think it makes some. Yes, yes, Pearl.
Ma'am, the CGFSA already has power,
Mm-hmm.
since it's food central government food, it's an agency for all the central government food standard agency for the whole government. And initially they didn't had interest in the
Yes,
uh,
yes, yes.
Pirlo Pasta Limited, since there was no complaints. And now, since they have made a complaint on the issue, they have got the interest and the power. So they have shifted from keep satisfied to keep player.
Very good, very good, very good. We are not discussing about Perlo Pasta Limited. We are discussing the question is about uh, CGFSA. We are focusing on CGFSA. So, what was CGFSA earlier? Um, it didn't have so much of interest. Level of interest was low. After the complaint received from Perlo Pasta, then they started taking action. So, their level of interest grew. So, now the managing director of Perlo has identified that CGFSA's position has moved from one quadrant to another quadrant. So, the earlier quadrant was their power was high, but their interest was low. But now their interest has increased. Yes, very good. So the key point here, the minute we read Perlo pasta, don't go with Perlo pasta. We have to go with the final thing is we have to identify how CGFSA has moved from one quarter to another. Very good, Pearl. 27th question. RRL is a medium-sized company that operates bus services throughout several major towns and cities. RBL has around 700 employees, and around 85% of these employees are members of the OOB union. OOB is an active union and has regularly threatened RRL with strike action during disputes over employee pay and conditions. Which one of the following is a major source of stakeholder power that OOB union has over RRL? Okay, resource, expert, system, positional. Maunika has given A. A is resource. Others, please respond. Why A? Any key point? Why A? Why A? Why A? One key important point we can understand then why A. A is resource. So, which point highlights that it is A? It's not positional per 85% of these employees, 85% of these employees are members of OUB, and they have around 700 employees. That's right. That's right. That's right. Okay, good. It's not D, it's A. Okay. Let's 28, 29 will do, and then we'll go to the PPT to continue with governance, ethics, and corporate social responsibility. R is a national chain of supermarkets. It has recently purchased a large piece of land in the center of a small traditional fishing town with a view to building a large store. There has been significant resistance to this by local residents, but in response, R has promised to create a sizable amount of free car parking for residents as well as investment in local sports and entertainment facilities. According to SIT and March, R is adopting which one of the following stakeholder conflict resolution strategies? See, there was a resistance from the residents of that particular area when what was they want to build a large store. So when there was a plan to build a large store, there has been significant resistance by the residents. So to satisfy them to uh, solve this issue, the strategy which they have adopted was, but in response, R has promised to create a sizable amount of free car parking for residents. So when they were opposing this large store, they have come out with another alternative. So alternative was provided to them. So we call that as side payments. not sequential attention. When they're side payments are where a stakeholder's primary objectives cannot be met, so they are compensated in some other way. So that is side payments. So if there is an opposition from for one thing, to solve that, they create some other benefit for them. So they sequential attention is when management focus on stakeholders' needs in turns. So one after the other in sequence they go about it. Then it is called as sequential attention. But nowadays, when there is an opposition from them, so immediately what are they doing? They are providing them some other facility. When there was a resistance, they are providing them some free car parking facility for residents and all. So that's side payment. Do you agree, all of you? The answer is side payments. 29th, which one of the following groups would an organization consider when planning a non-market strategy? Let's see who are non-market strategy. Okay. Then now primary objective not being met. What does it mean? It says that um, they want to build a land store. So that's their primary objective. So when that primary objective was not being met because of a resistance from that, they have promised them that they will provide some car parking facility. So in the purpose or in pursuit of fulfilling their primary objective, they are also taking up another activity of building something else for the resident. So when their primary objective was not met, which was to build a large store, when that was not met, then they are taking up some other objective also, some way to appease them, to satisfy them, to see that their objective can be fulfilled. That is the main point. Okay. So I think 29th answer, after I put the slide, I think it should be clear. Which one is the answer? Non-market strategy. Who are the players here? Non-market strategy. I put the slide immediately. You should be able to quickly respond. With the slide. Yeah. Government regulators, not major customers. Customer is a major market strategy. Customers fall under that. But here, now we see that it is government regulators. B, not A. I hope this is clear to all of you till here. Then we'll go back to the PPT, continue with the next topic about governance, ethics, and corporate social responsibility. Well, you're convinced? Okay. The next topic is what's corporate governance. Initially, the definition of corporate governance was given by um, a report in 1992 called as the Cadbury Report. That's the basis for the entire concept of corporate governance. So in simple terms, what we understand is governance of the corporate. So who would govern the corporate is the issue there. So corporate governance is, has gained a lot of importance after this thing. And then every organization started adopting this concept of corporate governance. So now in the annual report, there is a special mention about how they are governing their organization, what is the corporate governance, the guidelines, the principles, who constitute the body, and all those things are mentioned in their annual reports. It has gained a lot of importance after this. But what does the report actually talk about? It provides a useful definition. The simple definition talks about the system by which companies are directed and controlled. So it's talking about how to govern the organization. So to govern the organization, to govern the corporate, what system are they adopting? The system in which the companies are directed and controlled, for that they would have guidelines, they would have principles, policies, procedures, what ought to be done, taken up, and all would be discussed in that. So then, according to that, the governance takes place. Right. So the simple definition talks about the system by which companies are directed and controlled. But then the expansion might also include about the in the interest of shareholders, like highlighting the agency issue. Um, okay, agency issue involved, and in relation to those beyond the company boundaries, or and stakeholders, suggesting a more broader definition that brings in concerns over corporate over social responsibility. What is agency theory? Are you aware of what is agency theory? I think by now you must have come across somewhere. Okay. Any one of you have an idea about what is agency theory? Who are the owners of the organization? The owners of the organization are the shareholders. But do they run the business? They do not manage the business. They only invest the amount in the business. In the corporate, they invest their amount. In return of this amount, they earn a return. So the returns which are earned by the organization are distributed to them, or distributable to them. So they belong to the owners. They do not run the organization, they only invest that, but they are still the owners because they invest their amount. Who runs the business then in that case? The management, the board of directors, they run the business, they manage the affairs of the business. So who are they? Now they are not the owners when they run the business. Then if they are not the owners, what are they? They are in the role of an agent. They are acting on behalf of the shareholders. They act on behalf of the investors to see that with their actions, their decisions, their activities, they earn a return which belongs to the shareholders. So they are in the capacity of an agent, the management or the board of directors. That's the concept of agency theory. Am I clear? Is that clear? So the expansion also further includes it's about how the companies are directed and controlled. Is the summary part of corporate governance. But this can further include about the agency issue. Agency issue is now the agency issue where the management is working for the shareholders. So they are acting in the capacity, the shareholders or the owners of the company. Now they are acting on behalf of the shareholders or of the owners in the capacity of being an agent. And in relation to those beyond the company boundaries, so it also looks at um, those relations which are beyond the company boundaries, and stakeholders suggesting a much broader definition that brings in concerns over social response. So those aspects are also highlighted. So in simple terms, if you have to answer what does it mean by corporate governance, you can talk about it as governing the corporate or managing the corporate. So how the corporate will be directed, managed, controlled, um, is covered under corporate governance. So, managing the corporate is called as corporate governance. Governing the corporate governance. Okay. Now, what do we have to understand here about corporate governance, which is covered as part of your syllabus? What is that you have to learn? Okay, the areas which are to be understood are when the corporates are run by the group of management or management people, group of people, when they manage that, um, what are the things which they have to take into consideration? The first one talks about better disclosure for stakeholders. Okay, on account of running the business, from time to time, various accounting bodies have come out with various solutions to see that the organizations are run in a better manner, wherein uh, one of the points which they have mentioned includes about the disclosure part of it. Okay, financial statements do not disclose all the activities of the business. The definition of accounting itself says that those that can be measured in terms of money. The definition is restricted to only that part of it. Those that can be measured in monetary value are accounted. The art and science of recording, classifying, summarizing those transactions that can be measured in terms of money. But there are so many transactions which cannot be measured in terms of money, are not accounted for. Like if there is an MOU signed with any organization, if they have entered into a lease agreement, the terms, the time duration of the lease agreement, or if there is a factoring of their receivables, there are certain things which are not measured in terms of money. So now day-to-day transactions also, suppose there is a strike called off. There is no mention about us when was the day when the strike was called off. If there is a dispute between two levels of management or between two managers, manager and the employees, now when there are disputes called off, and that definitely affects the efficiency of the business. Now there are certain transactions which are not recorded in the financial statements, because the definition is restricted only to that part of it which says that those transactions which can be measured in terms of money. So what about those transactions which are not measurable in terms of money? So that would not be known, but that has greater importance. If there is an MOU signed with some organization wherein they can get benefit for in the future for a longer period of time or for a set period of time, now they have liabilities of paying operating lease amount to their lessor. Now these things, what is their, what, in what way are they benefited, what are their responsibilities and liabilities, would not be projected by the financial statement. So then the stakeholders do not have the full information. In that case, they cannot take better decisions. If they understand that yes, there is scope, better scope for the organization to do well because of so many agreements which they have signed up with so many prominent organizations. They are going to get benefited, or if they are under lot of pressure to meet their expenses or payments in future, their liabilities are in this particular fashion. If that cannot be understood properly, the stakeholders do not have full information. But then, when corporate governance, this concept was introduced, it is also focusing on complete disclosure, full disclosure. So, if the financial statements are not giving a scope to disclose certain transactions, there is a way in which these transactions should be highlighted. That is, they are disclosed in the footnotes. There is another section in the disclosure part of it which is called as footnote. Note about the financial statement. Notes to the financial statement. So there are various terms which are used. Either it's called as a footnote or notes to financial statement. They are accounted. They are reported there. They are included. These details are included in that. Then it also talks about how they organize, how they run their business, how they control their business. There is an important aspect about controlling. So how do they control? Controlling doesn't come just like that. There should be some systematic way in which control can be exercised. So there are suggestions given by accounting bodies about what control systems can be incorporated or adopted by organizations. Now, when there is a control exercised, it means that it is well managed by the organization. So, what are the control related issues? So, then it was made um, it was also seen that this there is a report about what control measures are they taking, what is the system of internal control which they are adopting, how do they control the affairs of the organization. So there is a report which is prepared, and now that report is integrated with the annual reports, the financial statement reports. The financial statements, when they are prepared and they are published in the annual reports, along with these financial statements, the other details about control system, a report is prepared on the control system. Those things are also included in the annual report. So annual reports, it is not only the financial position, which is the traditional trading P&L account, balance sheet, what we understand, the cash flow statement, what we understand. They are not only restricted to that. There are so many other things which are also um, followed and prepared. They are also integrated with the financial statement and included in the annual reports which are published annually. So when there is a governance system, that helps in better disclosure for stakeholders. Stakeholders will have information about various aspects. Full information is available so that they can take better decisions um, in terms of that organization. So better disclosure is one thing. Better disclosure is not only restricted to the financial statement, disclosure of financial statement. It also talks about, it also highlights the various stakeholders, their interest in the organization. Accordingly, when the disclosure takes place, um, this is possible because there is someone there to govern the organization who keeps the track of all this information. Reports are prepared, and these reports are integrated with the financial statements, and then they are included in the annual report. So, better disclosure for stakeholders. That's one reason. Reduction of perceived risk. Now, what does it mean by reduction of perceived risk? What is risk? If you understand the term risk, what is risk? Are you there? Nobody's responding. I have asked you a question about what is risk. So when you are so silent, risk is unforeseen incident, uncertain event. Yes, 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 yes. Any more answers? Risk is risk is uncertain event. Uncertain event. Yes, uncertain event. What is uncertainty? Too technical. Risk is unforeseen incident is also correct. Uncertain event is also correct. Then, um, technically, when we put what is that is future is anticipated, forecasted, and there is something which is expected for the future. That's what is planning about. Planning is about expecting or forecasting, predicting the future. When there is a variation in this predictions, when there is a variation in what is expected, then we call that as risk. We also call that as uncertainty. Both of them are variation in what would happen, what is expected, variation in the expected result from the future. How do we differentiate these things? If there is a variation, what is the chance of a variation happening? What is the chance of um, the expected thing not happening? If that probability is known, we call it as risk. If the probability is not known, we call it as uncertain. Both of them basically talk about a situation where what is expected does not happen or what is not expected happens. The chance of such variations happening in the future, if it is known, the probability, if it is known, we call that as risk. If the probability is also not known, we call it as uncertainty. But technically, most of the time interchangeably we use the terms risk and uncertainty. Okay, so there is variation in what is expected is risk. Now, reduction of perceived risk. How does it happen? How does it happen about the perceived risk can be reduced? Now, it's procedure about what we have to understand. When there is proper planning, when there is management of the organization, when you are expecting certain things for the future, at the time you also expect for the future. Uh, what are the things which can cause some loss to the organization? So it's specifically, very specifically, we have to understand about what is the loss, monetary value, the loss which can happen to the organization. But how will loss happen? It is not only all the time in terms of a loss earned because they were unable to sell the units. That is not the only situation. There could be so many things. There could be a loss on account of government regulation, government policy. There is a change in taxation rule. It could be the change in demand. The suppliers fail to supply. The customers' taste and preferences have changed. The competitors were very powerful. There was theft in the organization, embezzlement, theft. There was an accident in the organization. There are so many events which can result in a loss. So first step is we have to identify. Now when we're talking about loss, loss is on account of what is what we have to identify. First, we have to identify what are the events, list out all the events. Events could be internal, events could be external. So first identify what are the events which can cause a loss to the business. So you are also, apart from running the business, operating the business, the operation in terms of manufacturing goods, buying of raw material, manufacturing goods and selling these goods. Apart from that, it also gives a chance to look at what are the events which can affect the business. So first, the step is what are the events which can affect the business? What are the events which can cause loss to the business should be first identified. After the events are identified, what is the consequence of this event? So if there is an event, now event starting from embezzlement, theft, or errors in the um, financial statements, misappropriation of resources, allocation of resources was not proper. The employees were not serious about their work. There were too many mistakes. Internally, there were accidents, fire accidents, those things. External environment, we can think about various stakeholders, starting from government, investors, suppliers, customers, competitors. There are so many factors which can affect externally also. So list out all of them. But just by listing it out, it doesn't mean that all of them may happen. But once you are aware of what are the things which can cause loss to the business, once that idea, that understanding is there, then it helps them to manage those events better. So if there is something like that which is foreseen for the future, in that case, it also gives them a chance to understand what is the consequence of these events. So the consequence of events, if it is resulting in a loss, also should be estimated. After estimating the loss, what is the chance that such a thing will happen? So if we say that now we are in rainy season, if we say that tomorrow it is going to rain. So if it rains for a street vendor, it will cause a loss to him, because when it rains, he has to close down his small shop kind of thing, or small unit what he has put on the road. Then it causes a loss to him. But just because it is rainy season every single day, will it rain? It doesn't rain. Then we understand what is the probability of a rain happening. So that also has to be considered. So what is the chance of a rain happening uh, will be taken. What if it rains? What is the loss for that street vendor will be taken, and what is the chance of the rain happening also will be taken, and both of them are multiplied, and how much loss will occur to that will happen to that street vendor is estimated. Similarly, for an organization also, mere listing of events will not result in a loss. Once you list out all the events, what is the loss on account of that is listed out, and what is the chance of such a loss happening also will be calculated. Then you overall on account of all the risky events, what is the total amount of loss which will happen. Then once this understanding is there, then they can prepare themselves. So then, in such a situation, the if it rains, the street vendor will have some alternative, something. Maybe he will build something so that he can protect his goods from getting, drenched in that rain and all. Some measures he will take so that his goods are not, uh, lost in that rain and all. So also, when the events are understood, when the loss on account of these events can be estimated, then measures will be taken to see that they can safeguard themselves against these events which can result in a loss. So, handling that risk, management of risk will become possible, because there's someone there to direct and control the organization. So, they also get a chance to understand what situations can cause loss to the organization. So, if that is identified, if the situation is identified and the severity is understood, then measures can be taken to face those losses. Suppose it is prone to accidents, prone to fire accidents, then measures will be taken to see that fire accidents can be, faced effectively, um, without causing any damage to the organization, or it is in an area where natural calamities happen. So then they can take measures about how to protect themselves against natural calamities. In situations where still there is loss, maybe they can go for um, taking some insurance against these natural calamities, hazards, and all. Um, like that, maybe if there is still loss, maybe they can enter into certain agreements, mitigate their losses and all. So there are alternatives which are available to face those risks. But then first we have to identify what are the risks, what are the events which can cause risk or which can cause loss to the organization. Then how to effectively manage these risks also will be understood. Once if we know that there will be some loss or some damage caused to the organization, in that case, it gives them a chance to manage it well, minimize their risk, minimize their loss from those events. So it helps in reduction of perceived risk. Okay. Then uh, the third one talks about increased transparency. Increased transparency because the information is included which can help various stakeholders. So various aspects of it is highlighted. So there is transparency. It is not that it will not result in misrepresentation and misrepresentation of the financial statement. Um, at the beginning of this century, there were so many accounting frauds which have come into light. Even in India also, we've seen there were certain companies which had, which had to be closed on account of accounting frauds which have taken place. Um, there were accounting policies which were supporting their misrepresentation. So they've taken um, they have taken uh, shelter of this these principles, accounting principles, whatever are the loopholes in these accounting principles, they've taken the shelter under that and then started accounting this information in such a way that it has resulted in a fraud happening in the organization. So there were many accounting frauds, even in USA also, that has resulted in a recession. So then this was all possible because uh, there was no transparency. There was misrepresentation. The financial statement was not represented appropriately. The complete disclosure was not there. So that has given the management a chance to be involved in accounting frauds. So now, with the help of corporate governance, now this has resulted in increased transparency. All the transactions, if they are not included in the financial statement, they are included somewhere else wherein the full information about the organization in all aspects, quantitative, qualitative, all aspects are disclosed. So now there is increased transparency. Then with this, the shareholders' confidence has increased. Okay, once the shareholders' confidence increases, what happens? It helps in increase of their net worth. When the shareholders trust in the organization, then they retain their investment in the organization, they continue to be the investors for the future. Okay, when such scenario prevails, now that gives a chance to other investors also to trust in the organization. When such a thing happens, then more and more investors get attracted to invest in the organization. The demand for their investment, their securities increase. When the demand increases, the price increases, which results in a better financial position. So the market value of their investments, their equity, their long-term debt, their bonds, they all increase. When the market value increases, the position of the company also becomes better. Okay, so it increases the shareholder confidence, and more investors get attracted, and the market value of their securities also increase. Okay, and it also ensures companies are run ethically. This is another very important aspect, that um, when there is governance, it ensures that they run the business ethically. So, whatever are the code of ethics, the corporate ethics which an organization has to follow, we're going to discuss that now. Now, they have to follow those principles, ethics, and then run the business in an ethical manner. Okay, that's very important, that ensuring companies are run ethically. So, that is another um, aim of corporate governance, to see that they provide information to various stakeholders. They also know how to manage the risk. Okay, So reduction of perceived risk. Then there's transparency, increased transparency. Shareholders' confidence is boosted, and it ensures that they follow ethical principles. Now, when they are disclosing everything, when there is transparency, when they are taking all possible measures to control the organization properly, okay, in that case, they are doing the right thing. So, doing the right thing so that it does not result in misrepresentation of the financial statement. Then they also ensure that they follow all the rules and regulations. They comply with the rules and regulations which are laid down by for the organization by various stakeholders. Now, government is government and the regulators. Now, they are the main ones who lay down the rules and regulations for the organization. So, compliance is another important part of it. So, they comply with the rules and regulations along with the um, fair presentation of their financial statements without any misrepresentation, transparency, and following the compliance part of it is an important thing. And they follow the ethical ethics of which are laid down for the organization, ensuring companies are run ethically. Am I clear? Is that clear? I hope you are there and not sleeping. Are you there? Okay. Is it clear? Okay. What are the purposes and objectives of corporate governance? Corporate governance, the purposes for private sector is different, and not for organization is different. For a private sector, their motive is to earn profit. For a not-for-profit organization, for public and the not-for-profit sectors, it's different. Now, for the private sector, where their purpose or their intention, their motive is to earn profit, the basic purpose of corporate governance is to monitor those parties within a company which control the resources owned by investors. Okay, the primary objective of sound corporate governance is to contribute to improved corporate governance performance and accountability in creating long-term shareholder value. The name itself, private sector, their focus is towards earning the profit. Profit belongs to shareholders or the investors. Their motive is profit. So it is to ensure that profit is made or profit is earned for the investors, for the shareholders, for the owners of the organization. So that is what is the basic motive behind the corporate governance. So when profit is maximized, it results in shareholder wealth maximization. So satisfying the shareholders, maximization of the shareholders' wealth is the focus here in case of private sector when corporate governance is incorporated in the organization. Okay, to monitor those parties within a company which control the resources owned by the investors. So if the shareholder wealth has to be maximized, then here it talks about monitoring those parties who are managing the resources. Okay. The second aspect of it says that to contribute to improved corporate performance and accountability. Improved performance and accountability in terms of maximizing the shareholders' wealth. That is in case of a private sector. Their objective is to maximize or earn profit. But if it is not for profit organization, the other day we have come across an MCQ, then and there I have explained to you about what is a not for profit organization. Let's once again look at what is not for profit organization. Their objective is not to make profit. So what are they? They are there to render some services to whatever is the set group. It could be to the entire community or a particular group of the community. Their objective is to render services, provide services. So their objective is not to make profit. It is not for profit organizations. So in that case, how are they evaluated? How is that they are managed? There is a concept called as value for money in such cases. So value for money It works on three elements. The other day we looked into what those three elements are: economy, effectiveness, and then efficiency. 1 plus 2, the first one, and the second one results in the third one. 1 plus 2 is equal to 3. That is the equation what we have to remember. First one is economy. Economy talks about cutting down on the cost. Economy, minimizing that. Economizing on the cost. Now here, when they are not focused on profit, how can profit be maximized? When they either increase their sales revenue or they cut down on their cost, then they maximize their profit. That is the equation of making profit. When they are focusing on um, generating revenue or cutting down on the cost. But here, the very objective itself is not profit. So there is no concept of looking into what is that they have what sales they have generated. But they can always look at what is the cost which they are incurring. So here it is understood in terms of how much cost is incurred as against the benefit which they have realized. Benefit is in terms of whether the objective was fulfilled. They are set for certain objectives, fulfillment of certain objectives. They want to serve the community at large or a particular group, or some objective would be there. So in terms of objective fulfillment, whatever is the cost which is incurred, does it justify? So this is called as cost benefit analysis. So what is their cost which they have incurred, and what is the benefit which they have gained out of that? How much benefit did they gain out of that is understood. So now in that case, they cannot just shell out their amount um, without getting any benefit. So what measures are they taking in terms of economizing on the cost? So a measure of inputs to achieve certain service or level of service. So input, what are the cost of those inputs as against what they have achieved, what benefit did they gain. It's called also called as cost benefit analysis. So whether they've taken any measures to economize, that's for value for money. First element. The second element talks about as much as the input is there output. So it's a measurement to compare the inputs and outputs. So then they are called as effective. Effectiveness is as much as the input is there, are they getting output out of that? So you spend hours and hours of preparation, but that is not reflected in terms of marks. Then there is a mismatch between the input and output. So also in case of a not-for-profit organization, they have to measure about what is their input and what is their output. If there is a measure between input and output, then that's called as, if there is a proper match between input and output, then we call that as effectiveness. Okay. The next one is efficiency. Okay. When both the things are there, that is economy and effectiveness, then we call that as efficient. We've already answered one question because that at that point of time I didn't want to skip that, so I said we'll finish it up there, and then we've looked at what are the TEs from that. I hope this is clear. Where now there is a very big list of what are the key concepts of governance. Okay, very big list of it. Please understand all of them because the questions reflect on these areas. Okay, the first one is fairness. What are the key concepts of governance? There should be fairness. That's the first point of it. A sense of equality in dealing with internal stakeholders, a sense of even handedness in dealing with external stakeholders, an ability to reach an equitable judgment in a given ethical situation. Fairness talks about um, not being biased, not taking the side of any one group or one party. Being fair, equitable judgment, equitable or fairness, not being biased, not um, bending towards one group and targeting another one. So the first key concept of governance is there should be fairness. Um, that is in terms of both the internal stakeholders as well as the external stakeholders, and in a given ethical situation also they should not take any the side of any one group, or they should not be bent towards one group and targeting another group. In such situations where judgment has to be taken, decision has to be taken, they have to have a fair attitude. That is fairness. So this is very important when they are governing that. Otherwise, because they are in the capacity of managing the organization, and if they are biased, if they are partial towards someone both internally and externally, their decisions can affect the organization. So the first principle which they have to follow is about fairness. They have to be fair. Should not be biased. They should not be partial. They should not take the side of any one um, individual or a group and targeting another one. If they have to take a decision, even if that affects their personal benefit, even if one party is someone with whom they are closely associated also, and the organization's benefit, they should take the decision in a fair manner. So, in ethical situations, their judgment should be fair, their decision should be fair, which can benefit the organization. It is not about benefit some individual. Um, so, suppose some friend or relative is there among these stakeholders, their judgment should not favor their close associates, their friends or relatives. So that should not be the case, but the judgment should be fair, not considering all these things, their relatives or their close associations. Then openness and transparency. So when the second concept of governance talks about openness and transparency. It is one of the underlying principles of corporate governance. It is one of the building blocks that underpin a sound system of governance. In particular, transparency is required in the agency relationship that exists between directors and, just now I was discussing about the agency relationship that exists between directors and investors. Okay, transparency means openness, clarity, lack of withholding or relevant information unless necessary. It has a default position of information provision rather than concealment. Right? Now, full disclosure. That's what we've learned in accounting principles also. Full disclosure. Everything has to be disclosed. Unless and until it is completely confidential, uh, it the information should be revealed. Now, here there is a dilemma about what should be revealed, what should not be revealed. Now, suppose um, a, a tender quotation is called from the supplier. Now, among the suppliers, somebody um, is a close associate of the management, they're not supposed to reveal that on account of transparency. They should not reveal the details of what is that situation of calling in for quotations or tenders. Such information should not be revealed. Confidentiality, the information which is not supposed to be revealed to anyone. Apart from that, all that should be revealed so that it helps the stakeholders to take better decisions. All that which has to be kept transparent should be transparent, and it should be open. Right? It says that in terms of definition, transparency means openness. Okay, clarity, lack of withholding of relevant information unless necessary. Right? It should not be withheld, but if it is confidential, it should not be revealed. That is the important one. Okay, first one is fairness, second one is transparency. Third one is innovation. Now, what is innovation? I mean, why innovation? Why innovation? Why do you think that should be a part of the key concepts of corporate governance? It talks about their adaptability to the changed environment. When the market changes, they should adapt to that changes. They should not be self-satisfied with their work and their position and their achievements, but rather they should adapt themselves to the changed environment, adopt the new technology, um, uh, the eagerness to grow, change, expand. Okay, for that, innovation is required. Okay, otherwise, that contentment, self-satisfaction, that satisfied attitude will not result in expanding, will not result in more profits and maximization of wealth. That will not help the organization. Wherein, if they change themselves, um, they move according to the market. If the market expects them to change it at a rapid speed, they should be able to change at that speed, right? In that case, they can survive. Otherwise, the competitors will overtake them, right? So it says that innovation occurs when a firm transforms knowledge and ideas into new products, process, and for the benefit of the firm and stakeholders. Then innovation and experimentation in reporting, allowing the business to move away from rigid compliance and towards better communication of its individual value creation story for its providers of finance capital. So innovation can also be implemented in the way it is reported. Then do you see that there is a change in the way financial statements are reported? Do you see that there is any innovation in accounting aspect, reporting aspect? Is there any innovation which is adopted? Tally, yes, very good. Technology is there. Earlier things were done manually. It would take them days and months together to just tally their financial statements. Okay. Now they are using softwares. Accounting softwares are there. Tally is one accounting software. Earlier auditing was done manually. A person would sit to verify manually, cross verifying their vouchers, receipts with the accounting transactions. Then if there are errors, that those were identified. Now it is done with the computerization systems. Enter one transaction and that is reflected wherever it is has to be reflected. Then there is integration of accounting information, the information which is provided by various departments. All that information is integrated. There are systems called as enterprise resource planning systems (ERP), where the information is integrated. Now here we see that there is innovation in terms of financial aspect also. Now they have to adopt according to the changed technology, but now it is much faster, much quicker, much better accuracy because it's done with the help of systems. Earlier, what would take days together, sometimes to match the transactions, whatever happened manually, it would uh, it would require a lot of man hours. That labor hours, man um, hours were used in doing that. Now it is at the click of a button that things are all verified and then up to date, updated everything, right? Then we see that ultimately innovation improves the firm's reporting performance to the benefit of investors and consumers. Because information is integrated, it can be easily retrieved. When it can be easily retrieved, then various stakeholders are benefited. Okay, fine. The benefit of investors is fine. What about consumers? Do you think they are also benefited with the help of innovation? Apart from the product, yes, the product is produced with lot of automation and all, so the consumer is benefited. Anything else, do you think that there is something about consumers and the innovation aspect? Of late, when you approach the stores and malls after you buy the products, what is that they ask you to first provide before you make the payment? Almost in all the malls and shops, we see that even in the retail store, the groceries where you and the shop where you purchase groceries also, they first ask you to, no, before feedback, they ask you. Of late, we do not see so many of them asking for feedback with their feedback forms. They ask you to give your phone number. They say that you are an account holder, you are a regular customer, so your account is maintained, and we keep adding some points to that. No matter how minimum those points are, also still there is an account maintained with that shop. Fine. Every time when you go again, you don't even have to produce that account, that membership card. You just have to give out your phone number. Once you give out your phone number, that phone number and your bill is attached. Then what happens? So they get to understand what is your taste, what is your buying pattern, what do you buy regularly, how frequently do you buy. All those details, that feedback is collected. How there is a system wherein the bill the details about the bill and the phone number are connected, and you as a consumer buying those units or those products, you are conveying your feedback. That is called as customers relationship management. And they go one step ahead, and then some of them they keep sending wishes on prominent dates like birthdays and other events to celebrate. Then they remember the anniversary dates, the birthdays, and then some important things, and they wish on festivals. They keep informing that there is a discount sale and all. So that's called as customer relationship management. So innovation is also helping the consumers. Okay. Then much of you're aware of that, isn't it? Are you aware that feed phone numbers are connected to the bill? Huh. Okay. That's called as customer relation management. Then much of the knowledge from which innovation stems is tactic and local, meaning that such knowledge is unique to the company and environment in which the knowledge arises. In addition, the capacity of a firm to integrate external knowledge is crucial for successful information. They can understand when once these details are collected, they can understand as to how should they take up their production, how frequently the customers buy, so how much stock should be kept available for the customers. Then some analysis done. Okay, now the latest analysis and the softwares which are available, we call it as digital marketing and all. They gather the information from various sources. Even if it is not official, sometimes some of the social media also information is collected. You must have observed that if you search for any product on Google, the next few days you see advertisements coming up, popping up related to that product. So there are various options which are provided to you because you are interested to buy a product. So how does that happen? Because this information is captured by some software and it is addressing the consumer or the customer. What's IoT? then it gives them an idea about what to produce. Internet of Things. Okay. I'm really sorry for that. The next concept is skepticism. Skeptic, skepticism um, is an attitude which includes a questioning mind. Okay, uh, some of them have this attitude. Maybe we call this as a negative thinking, but then they do not trust it immediately, and then they keep this. They have a questioning mind, being alert to conditions which may indicate possible misstatement due to error or fraud. This is to provide a critical assessment of evidence. So, being skeptical is also needed. It is not accepting as things occur, but it is about questioning why and how. So that they are extra cautious about error or fraud not happening. So you will not be there on Saturday and Sunday, isn't it? Saturday, I assume it is a holiday for you. Is it a holiday for you? Okay. So tomorrow being a Friday, so we'll take 3 hours on Friday. Monday, Tuesday also 3 hours. So with that, Monday, Tuesday, Wednesday, Thursday, Friday. So from this Friday till the next Friday, our classes will be for 3 hours, so that whatever I have missed will be covered. Do you not have any other classes apart from this? Do you have other classes also? Okay, this is the only class. So spending 3 hours for one class is not an issue. Unless you have another class, then it would be a problem. But otherwise, it's fine. I think we can take 3 hours and then finish off whatever is that. The next one is independence. Independence from personal influence of senior management for non-executive directors. Independence of the board from operational involvement. Independence of directorship from overt personal motivation, since the organization should be run for the benefit of its owners. A quality possessed by individuals and refers to the avoidance of being unduly influenced by a vested interest. Then this freedom enables a more objective position to be taken on issues compared to those who consider vested interests of their of, or, or other loyalties. Now, what does it mean? Independence here it talks about the management who's running the organization. They also have their interest in the organization. Now they are benefited if the organization makes profit. If the profitability is good, they are also benefited out of that, right? Why? Because they have their performance evaluated based on that, and they are most of the time entitled to some kind of benefit in form of bonus, commission, some reward, something which they are benefited out of that. The management, people who are running the organization, it is not that they run the organization independently, only causing benefit to the um, shareholders. Shareholders' wealth maximization. They are acting as agents on behalf of the shareholders. So that's their relationship. But then again, there is a kind of dysfunctional behavior which arises on part of the management. Why? Because if the organization gets benefited, then they are benefited. So in this process, what happens is they can be involved in certain manipulative manner. That is, they can project the financial position to be better, inflate the profitability, delay certain transactions being recorded, though the transactions were completed. They do not record those transactions, delay them, um, project the financial position to be better. So, independence talks about independence from personal influence of senior management for non-executive directors. Um, Here it talks about personal influence of senior management for the position of non-executive directors. Then independence of board from operational involvement. So um, in the day-to-day activities, the decisions which involve the operational activities, they are not supposed to be involved in that. So independence from that. So the people at the operational level, they run the business, but then the day-to-day transaction, the decision, that the top management should not be involved in, because they do not understand. They only have the overview of the organization, but the people at the functional levels, at the operational level, they understand it better. So independence of the board from operational involvement, independence of directorship from overt personal motivation, since the organization should be run for the benefit of its owners. So because they are also benefited if their shareholders are benefited. If their profitability position is good, then they are also benefited. Therefore, uh, they keep involving in the affairs of that in the organization. In This is called as a dysfunctional behavior, wherein their behavior is in a manner wherein um, their personal benefit is at the forefront. Okay, a quality possessed by individuals and refers to the avoidance of being unduly influenced by a vested interest. So, for their benefit, they should not be. It says that influence. They should not be influenced, because their motive is to earn that reward or earn that bonus, or that for that their activities should not be um, influenced with the fact that they would get benefited if their the profitability of the company is good. Okay, this freedom enables a more objective position to be taken on issues compared to those considered vested interests or other loyalties. Then, if they are independent of these issues and activities, it will result in a better decision by these people of that management cadre, okay, who consider vested interests or other loyalties. The next feature, probity or honesty. So there should be honesty, honesty in financial or positional reporting, perception of honesty of the finance team from internal external stakeholders, foundation ethical stances in both principles and rules based systems. They have to be honest. Okay, it goes something towards something being as fairness, but fairness there, that is fairness here sounds, sometimes it sounds similar to honesty. Fairness is being unbiased. Okay, here it is being true. Honesty is being true. Okay? The right things, to include the right things, the right ones. Then responsibility. Another key concept of thing is responsibility. Willingness to accept liability for the outcome of governance decisions, clarity in the definition of roles and responsibilities for action, conscientious business and personal behavior. They should be willing to take the responsibility, stand by for all the decisions which they have taken. Fine, they have to take up the responsibility of all the decisions which they have taken. Accountability. Okay, answerability, accountability, the obligation of an individual or organization to account for its actions and activities. They should be willing to take the responsibility. If there is any if there is any unfavorable situation arising, they should also be answerable to that. Okay, accountability for whatever are the decisions which they have taken, for the results which were the outcome of their decision. They have to give an account of that accountability. Okay, accounting for business position as a result of acceptance of responsibility, providing clarity in communication channels with internal and external stakeholders, development and maintenance of risk management and control systems. So when there is responsibility given, when there is a responsibility given to take the decisions, authority is given. With the authority, decision making happens. With the decision making, the results, then the responsibility also should be taken as as a part of this decision making. Whatever are the results, for those results, the um, management should also be accountable. They cannot take decisions as they like, but they should take decisions which favor the organization. So they are also answerable to that. Then the reputation part of it is important. Developing and sustaining personal reputation through other moral virtues. Okay, then developing and sustaining moral stances of the organization and the industry in which it operates. So they also have to take care of the reputation of the organization. Judgment is another one, the ability to reach and communicate meaningful conclusions. So their ability to take better judgments or decisions. They should be able to weigh um, up numerous issues and give each due consideration. The development of a balanced and evaluated approach to make decisions in the best interest of the organization. Judgment. Last one is integrity. Integrity is being right even when someone is not observing. Okay, that's integrity. Doing the right thing all the time. A steadfast adherence to strict ethical standards despite any other pressure to act otherwise. Even if there is any pressure also not to do the right thing, in spite of that also doing the right thing, it forms under integrity. Describes the personal ethical position of the highest standard of professionalism and probity. It is an underlying and underpinning principle of corporate governance, and it is required that all those representing shareholder interest in agency relationship both possesses and exercise absolute integrity at all times, even if there is no one to observe them. So doing the right thing at all times. Okay, that's integrity. Even if there is any pressure, also not yielding to that pressure, doing the right thing, um, and exhibiting that highest standard of professionalism and honesty is a part of integrity, right? So doing the right thing at the right time is what is needed by the management. Now, when we are talking about corporate governance, governing the corporate, how do they direct and control the corporate? Then who would do that? Then there is a relationship called as agency relationship, wherein for the benefit of the investors, the shareholders, the management on behalf of the shareholders take up the role of an agent and works in the best interest of the shareholders so that their wealth can be maximized. In case of managing the organization, running the organization, what key concepts should be followed is what we have understood till now. Um, it talks about fairness, transparency, innovation, skepticism, independence, probity or honesty, responsibility, accountability, reputation, judgment, and integrity. Fine. Um, then we don't have time that we can discuss on the MCQs. So tomorrow also some more topics we'll do. After that only we'll touch on the MCQs part of it. Right. Um, what is the impact of technologies on? So we'll see that corporate social responsibility aspect of it in tomorrow's class. I hope what we've learned in today's class is clear and you've understood that. Any doubts? Any doubts? Anyone? Okay. Shall we end the class here?